Business valuation is not an exact science. Nevertheless, it is a very useful tool to regulate investment flows. It helps us understand and differentiate different companies or investment assets and gives us information about what we can expect in the future. Business valuation dramatically reduces uncertainty in the investments that take place every day and makes our economy work better. The practice of business valuation has come a long way since it first emerged in the 19th century. It is still partly a science under development as it evolves through the opinions of leading valuers, changing regulations and standards, and what we can observe on public and private markets, especially since the information we have available is constantly increasing. Valuation is forward-looking, meaning that the return that can be expected from an asset in the future has greater weight than what has been achieved in the past. This makes judgment and experience some of the most important indicators of a good quality valuation. Unlike other valuation practices, startup valuation does not have set standards. What we rely on in practice is leading methods and practices. These are often very generalized methods with little details. The later the stage, in theory, the more reliable a valuation can become, as we can tell what the company's future earning power is with decreased risk or error. However, many are still clueless as to how to value pre-revenue startups. Do we have to value pre-revenue startups? Can't we just leave it up to negotiations? It's not strictly necessary to value pre-revenue startups. However, what we are not aware of is that in negotiation process, the negotiating parties are implicitly relying on some valuation know-how. This is based on the market environment and practices, and the return expected in specific markets is what determines how you can sell those instruments to investors. Founders and investors might agree on an implicit value without carrying out any complex financial calculations, but they are still relying on prevalent market knowledge based on valuation practices. Early stage businesses operate very differently from later stage companies, SMEs and corporations. But early-stage businesses can also differ wildly from each other. Not all young businesses are startups, but there isn't a clear-cut point to differentiate normal businesses from startups. Startups are usually considered fast-growing and scalable business models, usually focusing on growth rather than profits in the early stages. Some would define startup businesses as only those companies heavily based on new technologies. However, this could be because technology is what enables scalability, especially when a business is marketing a business model based on the latest trending technology. Now, most new businesses that start out with the idea of growing fast in the future are technology enabled. It is also not clearly defined when a company stops being a startup. You could say that it could be between year 5 and 10, but we still describe many companies having disruptive business models as being startups even after 10-15 years of operations in some rare cases. This is likely because they are still growing fast, as well as being continuously relevant in the startup world by acquiring or bringing to the market the latest trending technologies. When evaluating valuation methods to use for early-stage businesses, I would define startups as companies with a specific financing story that are expected to go through multiple rounds of funding before becoming established, and where an exit in the form of an acquisition or IPO is an expectation. This defines whether using typical startup valuation methods is preferred or whether to perform a standard valuation. However, this is highly dependent on the startup story, indicating what the company wants to achieve and how it wants to grow. Most entrepreneurs would define their new company as a startup, but not all of them have a suitable startup story to go with it. In conclusion, companies that plan to raise funds from venture capital funds and similar institutional investors, and that fit into the typical company profile sought out by VCs, can be valued using startup valuation methods. This is because a valuation is highly dependent on the transaction for which it is being prepared. Startups have little to no past financials to account for to predict the future, and the failure rate is high, but this applies to normal businesses during their early phases as well. There are many more reasons why valuations in these circumstances need a different approach. First is the added uncertainty of startups. New business models have no reliable data on possible future exits and likely fundraising paths. Very successful startups may even create new markets that disrupt older business models, therefore changing underlying market assumptions. Additionally, exit timing and multiples are fast changing as technology trends change fast in the startup market. Second is the practice of startup negotiations, financing, and portfolios. There is a gap in expectations between what founders may promise or think they can achieve and the probability that these expectations will materialize. And this gap in expectations is usually known and accepted by the investor. The portfolio strategy and structure of VC funds, which invest early and rely on long-term exits, require large winners to achieve a satisfactory return on the fund, as the very high risk afflicting the majority of early-stage companies needs to be balanced with a very high return, making normal businesses unsuitable for VC funding and leading many founders to overinflate their possibilities to fit into this model or to create a strategy that purposely fits into this model. Additionally, multiple rounds of funding lead to a high dilution of early-stage investors. And these fundraising transactions often have very particular rights and clauses attached. The only liquidity event from which an investor can earn a return is an exit, and therefore no return is earned from dividends in the typical shareholding contracts. Since an exit is a must, the conditions to enable a successful exit are usually planned from early on, including a favorable shareholding structure. The valuation scope, as it relates to a venture capital or similar round of funding, are therefore different from other transactions. Also, the VC investor has a strong role in facilitating future rounds of funding by introducing the startup to industry experts and pushing for a fast growth and exit. Third is the budgets and asymmetric information. At the same time, available budgets to outsource valuations to experts are low, and a strong weight is placed on negotiations. This links up to the fact that founders without extensive entrepreneurship experience may be unaware or not take into consideration how someone may turn a complex, fast-growing company into a profitable one, or how investors achieve returns in startup companies with more asymmetric information held by the two main negotiating parties. Startup valuation methods rely more on judgment due to the disconnect between expectations and reality, the lack of standards, and the intransparent data. A liquidation value is usually close to zero. Standards of value may vary depending on whether we are valuing a startup for a new round of funding, a startup portfolio asset, or a startup exit. The low liquidity is usually reflected in other valuation assumptions without the need for premiums and discounts. The income approach, the market approach, and the cost approach are the three methods for valuing a business. The capital structure of startups is usually absent of debts. Taxes are low, and the convertible instruments are assumed to convert into equity, simplifying income valuation methods. Using a typical discounted cash flow method is possible, but cash flows are unlikely to be relevant before the liquidity event. And the aim here is to reinvest cash to maximize the exit. A terminal value is difficult to calculate as projections need to be calculated until the company displays a sustainable growth. In the case of startups, the exit replaces the terminal value. However, calculating a terminal value can help for comparison purposes and for new emerging industries with no data. Since securing an investment for startups involves illustrating a best-case scenario, carrying out a valuation for startups involves producing additional scenarios or using high discount rates not consistent with the capital asset pricing model. Even when using a base case scenario and the modified capital asset pricing model, startup cash flows are subject to typical startup risks that SMEs are not subject to. This subjective cost of capital is then replaced by the fund's expected return on investment. Considering that the exit replaces the terminal value, combined income and market methods are common for startups. The market method is in fact used to calculate a future rather than a current possible exit. Another market method used for startups is a rule of thumb method and involves the analysis of similar stage rounds of funding with subjective adjustments. The lack of financial data for early-stage companies leads us to consider different types of transactions or companies and to include sector-specific multiples and other adjustments in the market method. The cost approach, instead, for startups is unsuitable for financing transactions, but it can be used for other purposes and for startups comparison. Many are against using advanced financial techniques for early-stage startups. Some say that it is not possible to create reliable financial projections. However, when considering quality financial plans, we have enough information available to decrease uncertainty and to learn from deviations in the financial plan. Some investors interpret a complex financial plan by a startup team as a lack of a hands-on approach, whereas a financial plan should be used for goal and strategy setting, rather than as a substitute for a hands-on approach by either the investor or the founder. Whereas it is crucial to assess the founder's reliability when significant milestones have not been achieved, the team is not the only thing that matters, and therefore the financial plan helps to justify and clarify the investment decisions made. Financial plans and valuations provide important information about the market, strategy, and financing possibilities. They do not provide a sure way to recognize investments that will fail, but they can classify the type of investments and avoid overfunding companies with little market potential. Using advanced financial techniques is therefore recommended for all companies that fit under the startup definition, whereas they do not provide the same value to those early-stage companies that do not fit this description.